Chapter number 1, How to avoid loss in the stock market. How Rohit, a retail investor, lost 10 lakh rupees in the stock market. Phase 1. Rohit invested a total of 1.5 lakh rupees through his stockbroker friend who used to invest on his behalf. Initially everything ran smoothly, but soon he lost 55% of his money, including brokerage and other charges. Phase 2. Rohit followed newspapers and other business channels. After seeing the bull trend, he got excited to make quick money and went for intraday trading. Even after trading 70% successfully, he ended up at 20% loss because the gain in 5 to 6 trading got wiped away by 2 to 3 loss-making trades. Phase 3. Now he accumulated well-known stocks and planned to hold them for the next few months. His portfolio showed a gain of 20% over 10 months. Then he came across an attractive offer of getting a loan against shares. He took the loan. Initially everything went good, but then the market took a U-turn, because of which Rohit panicked and was forced to sell his shares to maintain collateral and ended up with 25% loss. Phase 4. He now decided to go with a professional stock tips provider. One such provider mentioned about making money in a downward trading market through futures and options. Rohit booked 2 trial calls and both of them hit the target. He got confident and then invested a larger sum. Can you believe he suffered a 90% loss in the next 15 days? Why trading is sure short way of losing money for retail investors. Lack of time and expertise, not considering the brokerage and taxes while calculating profit and loss. They follow free trading tips that are dangerous. They get attracted towards paid trading tips scams and ended up losing both the invested amount and the subscription fee. Traps to be avoided. Temptation from friends, colleagues and neighbors. Everyone will share that they gained 10,000 rupees from the stocks in 10 to 5 days, but they won't share what they lost. Temptation from broker. No broker will tell you to purchase a stock and hold it for 2 to 3 years because in that he won't make money. Temptation from a so-called analyst. They will tell you to invest in bull run and don't tell you to buy stocks in a bearer market when the stocks are cheaper. Temptation from a stock tip provider. They sell their tips using false promises of 50% or more returns. Because if such is the case, then the tip provider should be a billionaire. Overconfidence. Don't get overconfident by returns during the bull run, as when the bear market comes you may end up losing everything you made. Only way to earn money consistently from stock market. Invest in great companies and hold them for an appropriate period, like Warren Buffett, who made his fortune by 22% annualized returns over 50 years. Chapter number 2, Stock market is not risky at all. Investing in FDs and post offices is believed to give safe and steady returns, but we never take into account inflation and taxes. Considering these factors, net return can become zero or even negative. Equity investment can't be neglected at all, because in the past decades, it has been observed that equity investment has overtaken all forms of investment when it comes to giving returns in long term. After studying for 20 years of your life to get a job, but when it comes to investing, we do it without any knowledge that leads to failure. Chapter number 3, First step of picking winning stocks. Instead of profits and sales figures which can be manipulated, look for return on equity. It is the net income return as a percentage of shareholders' equity. Go for stocks with ROE greater than 20%. Search companies with competitive advantage like Apple, increasing ROE over the past 5 to 10 years with greater operating margin and cash flow will help you recognize companies. Check debt to equity ratio. It is ratio total liabilities to total equities. If it is more than 1 and increasing over past few years, then do not go for such companies. Chapter number 4, How to evaluate management. You cannot visit the offices of all companies you hold stocks of to evaluate the management, nor you should depend upon the meetings of the CEO with a stock analyst, as the CEO will always present a good picture. Then how to evaluate the management? Number 1, shareholding pattern. If promoters, those who incorporated the company and their relatives, are increasing their shares, the result will always be good. Being the promoter, they know what is going on in the company. If promoters are decreasing their share, then it can have both negative and positive impacts. So dig deeper if promoters are decreasing their shares. Institutional investors. You have to study combined foreign institutional investors and domestic institutional investors. If they are increasing their shares, then it will have a positive impact or vice versa. Retail investors. If the percentage of the retail investors is increasing, then the stock will fall or vice versa. Dividend history and tax rate. Check tax rate from financials of the company and dividend history from BSE and NSE website. A higher dividend payout ratio with an increasing dividend rate means management is friendly with shareholders. Chapter number 5, Valuation. It matters much. If you invest in the best company, it still can go wrong if you purchase the stock at the wrong price. Common valuation tools. Number 1, price to earning ratio. Current market price by earnings per share. But PE ratio alone cannot determine the valuation of a stock. It is used in combination with the following. Compare with its historical average. If the current PE ratio is less than the average of the last 3 to 5 years, then the company is worth investment. Account tricks. E stands for earning and the companies can easily play with this factor. One-time income or expense. Look for one-time income or expense as it can decrease or increase the PE ratio respectively. Cyclical firms. Companies with fluctuating earnings are called cyclical firms. Car manufacturing companies come under this category. If you see a low PE ratio of such firms, don't rush to buy its stocks as its earning may drop in the future. Number 2, price to sell ratio. Current price of stock by sales per share. It is calculated by dividing the market capitalization of a company by its reported sales. Number 3, price to book ratio. Compares a stock price with its book value per share. Book value is the amount its shareholders will get if company liquidates completely. Lower the ratio, better the investment opportunity. Chapter number 6, when to buy and when to sell. The best time to buy. No one can predict the exact top and bottom of a stock over a specific period. You can't buy a stock at the bottom and sell at the top every time. Therefore, buy top quality stocks as soon as you find one. When to sell. For better opportunity. Don't get emotionally attached to a stock just because you have been holding it for the past several years. If you find a better stock, then shift to it. Wrong buying decision. If after investing you find that the buying decision was wrong, then exit from the stock at the earliest. Value is overstressed. One should exit from a stock if the valuation becomes too expensive. Change in fundamentals. If you purchase a stock because of a certain reason, then after a few months the original reason to buy the stock is not valid, then you should exit from the stock. Changes in management. Great management can turn an ordinary business into extraordinary, while bad management can turn a good business into a bad one. Chapter number 7, do's and don'ts to avoid loss in the stock market. Don't check the daily price quote. An investor generally goes 2 or 3 times through the stock prices daily. This can affect him in the following ways. Early profit booking. Everyone fears losing money, due to which you can get triggered to book small profits from stock which would have multiplied your investment over the long run. Premature exit. If you buy a stock after starting the business and it does not move for let's say 7 to 8 months, then it is hard to hold your conviction and you may exit from the stock prematurely if you check the stock price daily. Chapter number 8, how to construct your portfolio. Diversify. Diversification doesn't necessarily mean having 40 to 50 stocks or more stocks in your portfolio. A properly diversified portfolio must have a limited number of stocks but across different sectors. Problem with huge number of stocks in portfolio. Difficulty in tracking the stocks properly. Negatively affect your overall return. How to protect your portfolio in market crash. It is divided into 2 parts. Number 1, minor stock market crash. Index fall by 5 to 30%. Do not sell all your shares to buy at a lower level. Number 2, major stock market crash. Index fall by more than 50%. Don't expect to gain 20 to 30% when the market is falling by 50%. Even the best swimmer can't survive in tsunami. Avoid these stocks. Stocks to avoid: 1. High debt companies. Stocks to avoid: 2. Low promoter holdings and microcaps. Stocks to avoid: 3. Stocks touching new low. Stocks to avoid: 4. Too much popular stock. Stocks to avoid: 5. Costly acquisition. Chapter number 9. Is it required to follow an equity advisor? Based on the time available to you, you will fall under one of the following categories. Category A. If you can give more than 20 to 22 hours per week for the stock analysis, then you can master the art of trading in 3 to 5 years. Category B. If you can give only 1 to 2 hours per day, then you should go for an equity advisor. Category C. If you can't even dedicate 1 hour per day, then either go for a trustworthy equity advisor or invest in the mutual funds to earn money in the stock market. Chapter number 10. Quick formula to pick winning stock. Out of 500 listed companies, apply the following criteria to make a primary list. Last 3 years compound annual sales growth rate is more than 10%. Last 3 years compound annual profit growth rate is more than 12%, and you will get 40 to 80 companies matching all the criteria mentioned above. Thank you so much for watching this video. See you in the next video.